Good morning, sir. Um, this is the continuation of report of Mendoza about the risk banking. So we have liquidity risk. Liquidity risk for a bank is the risk of not being able to meet obligations in terms of funds demanded by clients. This applies to both sides of the balance sheet of banks. Examples: withdrawals of deposits and to loans drawn down by borrowing clients in terms of loan commitments made by the banks. Next, credit risk is also known as default risk. Credit risk is the risk that the borrower from a bank with default of the loan and or the interest payable, that is, will not perform in terms of the conditions other which the loan was granted. This is damaging to the bank not only because of the actual loss eventually incurred, but also in terms of the time that management and bank counsel expend on attempting to recover the loss or a portion of the loss. Asymmetric information, adverse selection, moral hazard. So lenders have asymmetric information, and this leads problem of adverse selection, which rears its ugly head before the loan is granted, and to moral hazard, which occurs after the loan is granted. Methods used by banks to mitigate credit risk include long-term customer relationships, loan commitments, collateral requirements, specialization lending, and credit derivatives. Next, currency risk. Currency risk is also called foreign exchange risk. Certain financial intermediaries' asset portfolios are made up of domestic and foreign securities. In the case of the latter, the portfolio will usually include foreign banks' deposits and securities such as treasury bill of the US and the UK governments. In addition, banks also play a major role in the spot, forward, and derivatives foreign exchange markets. Internationally, banks also have liabilities in foreign currencies. Next, counterparty risk. Each party to a deal has a party on the other side of the deal. Thus, each party is the counterparty to the other party, and each party is exposed to the other party may renege on the deal or be a fraudulent party to the deal. So if a party fails to settle a deal, the counterparty will do another deal which may not be as favorable and may result is a loss. As the unsettled deal, this risk is termed counterparty or settlement risk. Next, operational risk. Each bank has its unique definition of operational risk: information technology system risk, human resource risk, reputation risk, legal and documentation risk, and external risk. Next, information technology system risk is the bank rely information system technology for the smooth functioning of business. The business of the mainstream banks is complex because they operate through a branch system over a large geographic area, so have numerous clients and products on both the liability and asset segments on their balance sheets, and have to cope with complex accounting system and to comply stringent regulatory issues requiring multifaceted returns. Next, human resource risk. Human manage the business of banking. Human resources risk is the risk of insufficiency and inadequacy of human capital resources. Insufficiency refers to not having sufficient human capital to run the business, and inadequacy refers to needs of staff. Reputation risk. Reputation risk is the risk of negatively affecting the company's group image, which could prejudice its ability to retain and generate business. It will be evident that reputation risk is closely related to HRR. Then RR is a risk faced all companies, but is particularly crucial in the case of banks. So continuation of business depends on reputation, and any damage to the reputation can exchange liquidity risk. Banks' runs have been caused by damage to reputation. Next, compliance risk. Compliance risk is the risk of non-compliance with statutory requirements of the various levels of government. Regulatory requirements of regulators, in this case, the banking regulator. So, regulatory requirements of other regulators that may be applicable because the central bank usually regulates banks only. Regulatory requirements of the financial exchange, other generally accepted codes such as the corporate governance codes. So non-compliance may lead to the withdrawal of licenses to do business and to the incurring of penalties. This have severe RR fallout. Management of CR amounts to having in place comprehensive compliance reporting framework, ensuring that CR reporting is part of the internal and external audit process, ensuring that CR reporting is on the agenda of the audit committee of the board of directors. Legal and documentation risk. So legal and documentation risk is the risk of some unanticipated legal or documental hindrance that renders transactions incomplete or non-binding. External risk. External risk is risk that parties other than the bank itself undertake activities of fail to deliver essential resources and services that harm the banks in a financial or services that harm the banks in a financial or other sense, and natural disasters that affect the service viability of the business. Managing external risk involves identifying the potential external risk and managing them accordingly. That's all our reports, sir. Thank you for watching.